Okay. So I think many of you know me, and I also know you because we are all our InvesToday app subscribers. Okay. So I'll directly jump into the topic of this workshop. So in this workshop, we will learn the complete options trading strategies. Okay, let me share my screen so that it will be easy for you to catch up. Okay. So this workshop, we will learn all about the option trading, right? Okay. So we'll come from the side, from the basics. Okay. First, we will learn what are all the types of options. So we have only two types of options. Okay. One is the put option and one is the call option. What exactly is a put option? Okay, put options, whenever you see the market, whenever it is falling and there are different strike prices, okay, when the market falls, these put options will move up. Okay, the call option is like whenever the market is moving up, the call options will go up. We'll learn all about the option Greeks and alpha, gamma, theta, and all later. So first, let us understand what types of options are there. Okay, call option and put option. If anyone is very much new, you can just unmute and ask me the questions. So I hope all of you know about the market already. Okay, so we will see the difference between the option buyers and what option sellers. Okay, so option buyers, what happens usually the premiums will be okay. The limited risk will be there if you are an option buyer because whenever you buy an option, okay, so that can become zero but not comes to negative. Okay, that makes it very limited risk, but you will have an unlimited reward because it can go up to n number of times. There is no limit for any option to move. You might have seen the option moving from even 5 rupees to 500 rupees sometimes, and 500 rupees to zero. Okay, so there is an unlimited reward. That's where most of the people get attracted towards the option buying, but not every time an option buyer will be winning. The probability of winning will be very less in option buying. Okay, so usually when you buy an option, you'll get an probability of only 33% to 36%. Okay, now coming to the option seller. So option seller is like the margin amount is also required high. Okay, because you are writing a call option, there will be a limited profit. Say, suppose if you sell an option for any 100 rupees or 200 rupees or 500 rupees, that amount is your profit. Over and above that, you will not have any kind of unlimited profit kind of things. So the risk will be unlimited because when you sell an option at certain rate, okay, so it may go up any n number of time. So how to use option buying and selling both together to become a profitable trader? That is the very important topic what we will be covering in this workshop. Okay, so option buyers, low premium, limited risk, unlimited rewards. I will show you everything in the explanation when we are next. We will go to the strategies. So in this workshop, we are going to learn about the multiple strategies. Okay, if you see the strategies, so the first strategy we call it as we will learn about the short straddle. We will understand what is straddle, what is strangle. Okay, then what is short straddle, what is long straddle. Okay, so ratio spread, we will learn about the ratio spread. Okay, we will learn about the covered call. Covered call, what do you mean by covered call? I'll be covering each and every strategies like there are caller, put call spread, call calendar spread, double calendar spread, put back spread. Okay, so you might have heard about all these strategies. If not, you can just make it a note. Uh, okay, these are all the terminologies where the professional traders we use. Okay, we deploy our money in the form of strategies so that these strategies will be useful for a non-directional trades. Most of the strategies we use it for a non-directional and for directional also with a proper hedge. Okay, so let us start from the first strategy today. Okay, short straddle. So straddle is nothing but whenever, see, there is a long straddle and a short straddle. Okay. So we'll learn about the short straddle first and I will tell you about the long straddle. So short straddle is nothing but whenever you are selling an option. Okay. So that becomes a short straddle when you buy an option of ATM. See, options have three types of categorization. One is OTM. OTM is called as out the money. One is ATM. Okay. And one is ITM, in the money. Okay. So when you sell ATM call and put, okay, that becomes a short straddle. So you will make profit when the markets are sideways. You might have seen many of the times 70%, not in recent scenario due to geopolitical issues. Now it has become very volatile. When you see a market is not moving very volatile, at that time you need to have a short straddle. Okay, so usually we'll make profit when the market moves sideways. Okay, so sell next month or long term straddle that will give a wide range. Okay, collect premium about 400 to 500 rupees per straddle. So higher the VIX, higher should be the premium. Take position when the VIX is high due to the panic or just before the event. So now all the situations are very convenient now, right? So we now the VIX is very high. Okay, the premiums are very high. We will take if you take the positions. I will show you how exactly you can create a straddle by stimulator. We will use Sensible to use that. Okay, let me share that Sensible and show you how exactly will be the payout graph and what are all the adjustments we can do. Let me share the screen. Okay. So this is a Sensible platform. I think many of you know this. Okay, so this in here we can just see here. Okay, to create a short straddle, as I said. Okay, so to create a straddle, what I said is you have to come to build strategy. Okay, so selling ATM, right? ATM is nothing but at the money. So at the money in the sense, whenever the stock, so you can just see here, Nifty now it is trading at 22,331, right? So 22,300 will become at the money. So if you see here 22,300 or 350. So Nifty has a strike rate of every 50 rupees up and down, you will find the strike price. So selling at the money call. Now today it's an expiry. All the options you can see, every options has become zero. That's where the sellers make huge money when the options become zero. 95% of the options will become zero. Only very few ITMs will have the value. If you see 23,000, 22,300, right? So these are all ITM call options. So here is the call option, last traded price, and this side, right side, you will see a put option. Okay, if you see 22,002, 250, 200, 150, 100, all these things have a value. All other OTMs will become zero because it closed below 22,350. 350 call option becomes zero, 400 call option becomes zero. Now let's take next week and create a simple short straddle. Okay, short straddle, see if you see 22,300 is the strike price at the money. If you sell this and this. So if you see 22,300 call option has a premium of 454 rupees. Okay, and put option has a premium of 341 rupees. Okay, so if you sell these two, okay, this will be the payout graph here. You can just see here. So you will get a range of, say, Nifty, if it is closing between 21,500 to 23,095, plus or minus almost 3.5%. Wherever it closes, you make money. Okay, because you can just done. So selling here 7th April, on 7th of April, say suppose on 7th of April, if they we can just check out here on 7th of April, 8 days to expiry. Okay, this is how the payout graph works, and you can understand the statistics here. Maximum loss is unlimited because if the market moves in one direction, you will go under loss. So if the market stays between here 21,500 to 23,095, you will make profit. So the probability of profit, you can see here the probability of profit is 59%. Okay, and the time value 44,000, intrinsic value is 7,399. Fund needed is 2.61 lakh. See, because we are selling an option here, the margin requirement would be very high. Margin needed, as we are selling both call and put, after the adjustment, you'll margin required would be 2 lakh. Say, suppose how it works. If the market tomorrow, tomorrow is a holiday, okay, directly it will move to the Wednesday. Wednesday, say suppose if the market opens flat, okay, if the market opens flat, 22,300. So these options, you are already in a profit of, you can just check out here, profit is 6,881. You will be making it a profit of 3.3%. If the market doesn't move anywhere, if it is closing flat, if it moves, okay, 22,440, you still make a profit of 5,700. How this profit happens is because there will be a theta. If you see the option Greeks here, so here every options will have a delta, theta, okay, gamma, vega. There will be a decay in every stock because we assume that, okay, the market is not moving anywhere. So there will be a decay here. Okay, if you see here, if the market is closing same, you will get 44 points as a decay, which is, we call it as time decay, because a lot of people buy call option and put options, and if it's not moving, Aditya, tell me.
Raju sir, I'm aware of this strategy because I have also learned it from you in the past. But my question for you is, after explaining the strategy, please explain how to deal with the higher M2M swings if the market is very
Yes, we will
volatile.
come to that, Aditya, because a lot of users are new to this. So I'm just, this is the first class. I don't want to make them confused. So that's where I'm getting it from the basics.
Okay, sir. I just wanted to let you know that you should please address this concern in the end after explaining the strategy.
Yeah, how to adjust the things. Yeah, we will come
Yes.
to that one by
Okay,
one.
sir.
But
Okay.
people who doesn't know about the straddle and strangle only, so we'll complete, make them understand that, and then what if there is a movement, how to adjust it. We will go with that. I will add that adjustment, buying the hedges and all. We'll continue with that.
Okay, sir. Okay.
Hmm? Okay. So if it is very basic, you can join after some time or whenever there is a crucial strategies. I can
No,
again.
no, sir. I'll stay. There's nothing wrong in revision.
Okay, right. Okay, so this is how, see, if the market, if you feel that there is a sideways movement, so that's where we deploy this strategy. Due to the high wicks, we will get, say, suppose we get high premium, right? So if you say on Wednesday or Thursday also, if it is not moving, so you can just reset it. If the market is flat, 22,000, you will make 10,806 rupees. Okay, you can just check out the profit and loss table as well, on which, so usually if after 2 days, if the market is in the same stage, so this option will be, entry price will be 341, 341, 341. You will make here 10,800 rupees. So on that day, this 340 rupees premium will come to 272. because nothing went up, because people buy put options stating that it will come down. But if it is in the same situation, this 340 rupees will lose its value. That is what we call it as theta. It will come to 272. And the call option where people bought that, assuming that the market will go up, uh, the 454 rupees premium will be at 356. Okay, so that's where you have sold both of this. So this minus this is your profit into per lot. So you will get 10,800 rupees here. So that is how you can just see on, say, on 7th of April. Okay, so 7th of April is an expiry day. So whatever you have sold or whoever has bought it, that day every options will expire. Okay, either it has to become zero or it will come to its intrinsic value. Intrinsic value is nothing but, say, I will tell you to uh, intrinsic value is nothing but whenever you calculate the intrinsic value, say, suppose Nifty, if it is closing at 22,000, say 450. Okay, now you can just see here, this option will become zero, 22,300 put, because it is closing above 300. Okay, so this will become zero. And the call option, which you sold at 454, it will come to its intrinsic value 143. How this 143 came? Okay, this is how, because Nifty, if it is closing at 22,443, this minus your strike price. 22,443.05 minus 22,300, it will come to 143. On 7th of April, if the Nifty closes at 443, it will be 143. If it closes at 554, this will become 254 and you'll still make 35,000 profit. Like that, you can just come to the stimulator and see here, if it is going above, even if it is closing at 22,666, you still make 27,000 profit, which is 13% of your investment amount. Okay, and if it is closing at 22,778, you'll still make 20,621. You can see here, one option will become definitely zero, because if it is going up, this 22,300 put option will become zero, and whatever premium you have collected, it is your profit. And if the Nifty is keep going up, say, assume if it is going 889, you still make a profit, because you will go under loss where when it reaches above 3.4%. Still it is 2.5%. Okay, 3 point, even if it goes up to 23,000 and closes at 23,000, you still make 6,109 rupees profit. Why? Because this option will go to 700. You make 22,000 profit here, and you will lose here 16,000, because 23,000 people who have sold this 20, the intrinsic value here, if you minus 23,000 minus 22,300, the intrinsic value of that option would become 700 rupees. That's where the option which you have sold at 454 rupees, you have to cut down on that day at 701 rupees. Right? That's where on the date of expiry, there will be a lot of movement. Okay, short covering. Okay, so you have to be very careful when you are building a straddle. Okay, because the loss will be unlimited. You can see here, if it is going beyond 23,095, you will go under loss. So the probability is 59% you win, but over and above 3.5%, if it is moving, that's where you will go under loss. Now, so suppose you see, usually when the VIX is high, market is not going on a sideways. So VIX itself, it says that I am going to be a wild horse. Okay, either I'll be going up or coming down uh, very fast and very aggressively. So in that case, what happens is, how to avoid this. I will keep you posted how actually for 2 lakh investment, how we can uh, make a hedge position, because I don't want to lose maximum. Okay. So there is a option where you can convert this unlimited loss to a limited loss. Okay, so how can we do that? So our risk is, say, suppose our risk comes only when market moves 23,100. We can consider it 23,100, right? What if we buy a call? Okay, so you can buy a call option. You can add an option here. Okay, see, now on the same day when you deploy the strategy, you can go to, we call it as OTM. See, we are buying OTM now. Okay, this is ATM.
ये लाइट की
This will be OTM, OTM1, OTM2, OTM3, OTM4, OTM5. Okay, likewise, it will be keep going. So our risk is at 23,100, right? So if you come and see the option rate of 23,100, it is trading at 123 rupees. Say, suppose if you buy this, okay, so you can see here the lot, the if it is going up, the maximum loss on the upside, it will become only 8,000 rupees, right? In the same way, we have to cover this on the put option as well. Okay, say suppose on the downward side, we have a limit up to 21,630, right? 21,630, if you go and see 21,500, we can say this is the highest open interest what it has been built. If you buy this, okay, they here the maximum loss, okay, which was unlimited, so it came to limited. So maximum loss what you can occur is 19% of your deployed amount. You can see here the premium, the margin needed was almost 2 lakhs, right? So from 2 lakhs, it came to 81,000 because you have managed your risk. Okay. You have managed it. Of course, the maximum profit, which was, if you remove this, which was around 49,000, has come to 36,000 because we have sold this option and bought this option. Okay, we have collected the premium here of 341 rupees and paid a premium of 108 rupees. Okay, so this minus this is like, this is called as, we collected the credit here. You can just see here the premium you will get as 36,300. Okay, whatever after paying 108 rupees and 123 rupees. So this will, the probability of profit has come down because the range also came down because on the date of expiry. So if you go on 7th and if it is closing at 5% higher, you'll lose only 15,000. If you reset, say suppose if the market doesn't go anywhere, okay, so you will be making almost 43% of your profit by investing 81,000. You will be making 34,000 profit if the market closes at 22,331. So if it is closing 22,400, the profit margin will keep changing. Even if it goes up by 2%, you will be in profit of 12,800 rupees on the date of 7th April. Okay, you make still 16%. What if it is coming down by 1%, 2%?
क्या पड़ा था
Even if it is down by 2% from here,
बढ़ा लो
even if it is closes at
अभी
21,884, you still make 12%, which is 9,600. So it is always good to go for a straddle, okay, whenever you feel a range of plus or minus 3%. Now it is actually a good time to go for a straddle, short straddle and all. So what if it is moving in one direction? Say suppose today it was almost 2% down. If you see the trend, okay, you can always understand the trend here, how to recognize the trend and how to make the adjustment in the straddle if it is moving against your direction. Okay, so let me come to the trading view to understand the trend. Okay, this will help you in understanding the trend. Okay, if you come to Nifty, you can see here today's trend was completely negative. You can go to 5 minutes time frame, you can come to 15 minutes time frame. Okay, you can see here. At the end of this workshop, I will give you this code as well. So you access to this graph where you can easily analyze the trend in different time frames. So no premium subscription is required. You can just you see here in the 15 minutes time frame here it gave a sell call. So it's very simple if it is making a sell call here, and these are all the levels what we call it as CPR. So it's Camarilla points, central pivotal points. So whenever the market is below the pivot, okay, it is always negative. So today it opened below pivot. You can see here L3 was broken, L4 was broken, L5 was broken, L6 was broken. Okay, for every points you can just look at the trend here, and you can, if you are trading in 3 minutes, it's better to trade. If you have a straddle, you can go for usually 5 minutes. That will help you. Or if you are having a like next month, as I told you, this we have created for only a week time, right? So for week time you can just go for 15 minutes. So today if it is continuously falling, you can come here and there is no need to sell a put option and no need to buy a call option. Put option buy and put option sell if you read it. This will become a call bear spread where it will go in one-sided with 59,000 rupees. This will become a call bear spread. If the market is closing below 22,630, you will make 21,000 profit and maximum loss is 30,000. One is to almost, it is 0.721% reward. So the risk to reward will change here. So rather than going on, like you can just be a directional straddle also, you can just do it. Morning, if you sell a call option by looking at the graph, you can just sell a call here and wait for the buy to come, then you can sell a put option. So that will give you a more range, okay, rather than blindly going and selling call and put at the same time. If it is in purely sideways where the market is not moving, when it is consolidating, then you can sell a call and put. In the recent times, I have not seen any consolidation in the market. You can just see here either it is upward or downwards or upward or downward. See, consolidation market we have not seen from many days. Okay, so here is the consolidation from 16th February to 25th February. Here there was a huge consolidation. When the market is moving within a range, okay, so
मेरा
that is what we call it as consolidation. So this straddle, you can deploy it whenever there is a sideways movement. Okay, I hope you all are understanding. If you have any question, please ask me immediately. I know many people are very new. To understand the concept, it may take time, but yes, slowly. It's very easy. Okay, right? You're selling a call option and sell option, keeping your risk limit, but the probability will be. And if you don't want to buy these hedges, you can just completely sell a naked one, where it is always suggested to buy a options, okay, so that your maximum loss becomes limited and the margin benefit also you will get it. Any questions here on the straddle, short straddle? Okay. This is short straddle. As I said, if you go for a buying, this will become a long straddle. So you will make loss if it is market is between this range, okay, 21,500 to 23,095, and you will get unlimited profit, okay, when it moves directional. The maximum loss would be whatever the premium you have paid. You will not lose more than 51,000. But the probability, as I told you, for buyers, it will be very less, 41,000. 41% is the probability, and margin required is only 51,000 here. So a lot of people use this whenever there is an event. Okay, whenever there is an event kind of thing, you can go for long straddle, which will, because one will become zero and another will become it may go unlimited profit. This is advisable before the expiry when the VIX is very low, when there is a high momentum is expected, or if there is any stock is in results or something like that, binary events, then you can use the long straddle. Any doubts, guys, in this? Okay, that's where we define it here. Selling ATM call and put is called as short straddle. You will make profit when the market are sideways. I showed you the stimulation, right? Plus or minus. Even it is not sideways, you when the VIX is high, you will get a very non-directional trade. Even if it is going 3 point up, 3.5% down, you make very good profit, right? So in the same way, we have strangle. So let us understand the strangle. Strangle is nothing but selling an OTM. Okay, as I told you, there are three: ITM, ATM, OTM. OTM is above the strike rates, whatever. If the Nifty is trading at, say, 23,300, the call option OTM would be 23,400, 500, 600, 700, 800. All the options are OTM. For put, it will be 22,200, 22,100, 22,000. Option strike rates will become the OTM. So identify the supports and sell put. Okay, identify the resistance and sell call. So you will get a wider range. Okay, keep at least 400 points away, in the sense if the market is now trading at 22,300, right? So 400 points away, if you keep it, so you'll get a still wider range. So easy to do in the last 2 weeks. Long-term strangles is a good idea. I will show you the stimulation here. So what I say is we'll remove this. Okay. We'll come to Nifty again. We'll delete this. If you want to bring, I will show you by building a short strangle. Short strangle, what I said, is selling OTM, right? 22,300. This is the ATM. So 400 points above. Okay. 1, 2, 3, 4. 22,700. Call option. Now it is trading at 259. Okay. We have to sell this. Okay. And coming to put, 22,300. 400 points below. 1, 2, 3, 4. We can sell 21,900 or 22,000 is also fine. We can just check out the premium 200 rupees here. You can just go for any range. It's not necessary that you sell only 400 points above and below. You can go and sell 500, 600,000 points below as well. Okay, it purely depends upon your risk appetite. So the amount required here is again 2 lakh. If you see here, the Nifty range extended up to 21,500 and 23,180. The straddle when we sold, okay, the range, Nifty range was only about from 23,095 was the upper range, right? In this case, if you go for this kind of strangle, even if the Nifty is going 23,188, you can just come here, and on the 7th of April, even if the market moves up, you can see every day how much decay you will get. If you go directly on Wednesday, you will make 3% profit if nothing is moving. Okay, even if the market slightly moves upward, 1% up, you still make 2%. If it is down by the even 1%, okay, still you make 2%. You can just deploy it and exit in the morning. So this is even when the time on time basis, how much you will make, you will have a fair idea. Okay, if you see on Wednesday, okay, even if the market gap down by 1.5%, you still make 1.8% in a day time, right? Today is Monday, Tuesday is holiday, Wednesday, if the market comes down, you still make 3,300, 700. And if the market is gap up, I'm expecting some gap up opening on Wednesday. Let's see. Okay, even if it goes 1% up or 1.5% up, you'll still make 1,700 rupees on Wednesday. So say suppose on Thursday, if you go to Wednesday or Thursday, you still make higher percentage of profit even if it is going up. If it is not going anywhere, if it is intact, you will be making a maximum profit. You will already make 5% of the profit. Okay, that's where. So OTM by selling, this is called as short strangle. Okay, you understand the terminology so that whenever you want to deploy or when someone talks, you will be able to analyze easily. Okay, straddle is you'll get V shape like this, inverted V shape. In the strangle, you'll get from here to here, you'll get the same return, 31,000. Okay, maximum returns you will get it if it is in a range of 22,000 to 22,690. Okay, so what? To you can buy the hedges for this as well. As I told you, if you buy the hedges, the loss will come to limited, but the profit what we make will come down. So if you buy 23,300 call option or something, okay, you can just come here or buy 23,000. If you where you want to cut off. So on the upper side, you may lose only 4,800. The probability will come down. The margin will come down. The profit what you make is also will come down. So you will have a range of only 2.5% to 2.7%. Within this range, if it is closing, it will be you'll be making still 18% of the profit on your deployed amount. Understand the percentage of return is changing aggressively just because the amount used here, okay, is showing the returns for 81,000. And if you don't buy the hedges, you will get for 2 lakhs, it will be completely different. Okay, for 2 lakhs, you will make 16%. So with edges also, you'll make 18%. Without edges also, you'll make on 16 to 18%. It is always good to go with the edges. You can go with how to diversify your hedges into monthly, and if you go for next weekly, that will become a calendar spread. We'll come to that later. So today we will just understand the straddle and strangle. So straddle has two types: long straddle and short straddle. Okay, on in strangle we will have short straddle. And if you buy these two, that's how it will become a long strangle. Long strangle, usually people, one second, it says, right? If you buy this, okay, this is how the payout graph looks. So plus or minus 3.7%, you will lose. Okay, only you'll make profit only if it is going above that level. Okay, on 7th of April, if the market is closing anywhere between, even if it is closing at 22,200, 22,100, if 22,000, 21,800, you will lose 76% of your deployed amount. The maximum investment is only 31,000 because both the options will become zero. Okay, in one side, yes, it will calculate. If it is closing between 21,000, you can see here it will come to 3 rupees. If it is closing 22,100, both the option will become zero. So you will lose the whole premium, whatever you have paid. Okay, so that's why I tell you a lot of people, you should always use both the combination of buying and selling. The sellers have the highest probability. You can see here, if you sell these two, the probability of winning, making a profit is 62%. And if you buy this, the probability of profit will come down to 38%. So which one is better? 62% is better, right? Even though the investment is less here, okay, the profit is unlimited. People go and buy the options only because they want unlimited profit and the margin is less. That's why 90% of the people lose money in option buying. Okay, they buy at 259, assuming that the market will go up, even if the market in going in for at per the expectations within the time, if it doesn't reaches, your option becomes zero. So, and when it is coming down, people average it. Okay. By end of the day, on the date of expiry, you have to cover your position by averaging. Say, suppose if you buy this at 259 call option, even on the 7th of April, even if the market is moving up, okay, from today onwards, even if it goes up by 2.5%, 3%, you still make 12,000 loss. Or if you have only bought only call option, you still over and above 22,959 only you will make profit if you have bought only the call option. Okay. So that's why it is very important to understand the option selling statistics as well. Option sellers, say suppose if you have bought only the put option, assuming that the war situation market will come down and all, if you buy 22,000 put option, which is OTM, far away, so you will make profit only if the market is closing below 21,771, you will make profit. Yes, you will get unlimited profit. The percentage of also returns is very high, but the probability of profit is only 26%. Even if the market comes down, okay, you can say even 1%, 2% if it is down 21,880 on the date of expiry, you will lose everything. You will lose 8,000. Okay. So how to use straddle and strangle and the buying and selling combination, I will tell you with the bull spread. Now let's come to, I hope you understand the short straddle and strangle. Okay. Strategy one is was straddle, right? So strategy two is short strangle, we call it as. Now let us come to the ratio spread. So ratio spread, okay, is a shortcoming of short strangle. So if you have sold OTMs both, okay. So ratio spread is nothing but a short strangle with some buying. If you do some buying, because once you collect the premium, you can always give the same collected premium to hedge your position, right? Can use directional as well and non-directional strategies as well. I will show you flexibility in increasing or decreasing the risk reward ratio by adjusting the ratio. Okay, so this is, we call it as ratio spread. A ratio spread is a huge topic because ratios can be 1 is to 1, 1 is to 2, 1 is to 3, 1 is to 4. And how to do that, I will tell you in.
During our Corona time, only one day we had subscribed.
Okay.
He was the first one to.
Let's see this. Now let us build one ratio spread. Okay, so to build the ratio spread, as I told you, it's a shortcoming of short strangle. First, let us sell the short strangle. Okay, like on 7th April.
Yeah, negative.
Short strangle 22,300. Strangle is not means you have to sell OTM, right? So let's sell 22,600 call option. The premium is 300 rupees. Okay. So as you have sold, say suppose I am expecting, let's create a realistic strategy, which I am expecting some positiveness on Wednesday. So I cannot go blindly and buy a call option, right? So say what we do, usually people will do, we have to buy a call option. Which call option we have to buy? That is very important. So usually we can buy at 22,300 call option, which is at 454. So I assume that the market will go up. So that's why I first buy a call option of 22,300. Okay. By investing 29,000 rupees, I buy one call option. Okay. On Wednesday. Okay. If the market goes up by 0.5% or 1%. So I directly make a profit. What if the market doesn't go? Okay. So there is always a, because the probability is only 36%. Okay. What if the market doesn't go? On the date of expiry, even if you go, I'll lose almost 50% of the profit. Right? So, okay, let me. Can you mute? I will mute all so that. Okay, I bought by paying a premium of almost 454 rupees, right? So मैंने buy कर लिया यहाँ पे 29,000 invest कर लिया. What अगर if it is falling down? We never know. It's just a prediction, right? इसके लिए what we will do, we can sell a call option that will become a ratio. Okay, अगर 22,300 हमने 454, I will sell this call option at 388. Now if you see, my loss is only 4,000. Okay, the profit also will become limited here. If the market goes up, even the probability also increased here. So, Pele, without selling, my break even was 22,700. Once I sold it, even if the market is closing 22,300 and above, even if the market doesn't goes up, okay, on the date of expiry, we will reset this. Okay, on date of expiry, if it is slightly positive, okay, you'll not gain anything on the date of expiry, even if the market is just flat. Okay, if it is closing just 22,400 or even the flat, you will not lose the entire amount. You will lose only 4,000. The maximum loss is only 4,000 here. We are cutting off the loss because we paid 454 rupees premium and we collected 388. So I don't want to, I want to go a bit up bullish, but wide range, the probability. You can go and sell 22,500 options. So here the maximum profit will go to 5,000 and maximum loss is 7,000. You will not lose the whole capital. The probability will still remain the same. What if you sell again 22,600 call option? See, that's how it becomes. The probably went to 72% because even this becomes a call spread bearish strategy. This is actually even it's like, so how much ever the market falls, even agar market 20,000 pe aa gaya, I'm bullish hai, right? So if it goes up but not beyond 22,982, 3% ऊपर नहीं जाना चाहिए, उससे नीचे कितना भी अगर वो नीचे आ रहा है, so you will have a profit of 24,000 when it stays between almost 22,300 to 22,990. And if it is coming down, how much ever it falls, you will make 11,800 rupees, which is 6% of your deployed amount. Okay. But we have bought only one call option and sold two call option, right? So इसके लिए margin बहुत ही lucrative. So we want to cover this unlimited loss to limited one. I don't want to go to, because what if the market goes? See, we never say market goes by 5%. You will lose 33,000, which is 16%. Okay. To cut off this unlimited loss, okay, we can still go and buy another option. You can cut off your, but yeah, at 23,000. Okay. This is how this we call it as 1:1. Okay, two call option buy, two call option sell. So the maximum loss what you occur is 11,000 and 14,000 is the maximum profit. From here, 22,000, your 22,828 up to 2.2% you will make profit. Above 2.2% you will make loss. So that's why if you want to create a bullish strategy, you can just buy. This is called as bull spread. Okay, buying a call option and selling a call option, it will become a bull spread. And if you still want to make it a bullish, you can create a synthetic future by selling a put option. You can see here. Usually, I suggest people not. What do you say? Whenever you are bullish, it is better to go with a put bull spread, which will give you more comfort. Okay, so this is rather than buying a call option and selling a call option. What I will do if I want to go for a bullish strategy, I will just buy this put, okay, and sell this put. So from 22,222, okay, it can withstand again 0.5% fall, but wherever it closes, you will make profit. Even if the market closes flat on the date of expiry, you will be still in a profit of 14%. If the market doesn't go up, okay, even if it is down by almost 0.5%, okay, you'll still not lose anything. But if it is going up, you'll make good profit. Okay, with this, you can buy any of the call option if you want to make it unlimited. Okay, There are different. Now the VIX is very high. That's where wherever you buy, you are going to lose. Here and there, very wide range. So usually, if you want to go for, usually you can go and buy this. So you will not lose much here, 14,000. But when the market is going up, you will have very uh, aggressive profits. Okay. So likewise, you can use different ratio. I will tell you the ratios, like say, suppose if you buy 22,000 put, okay, and sell two lots of here. So you see here, the probability will become 84%. So wherever the market goes upside, you will not lose, and you will not lose till the market is down by 3.8%. Okay. So this bullish strategy will give you a comfort of, okay, so you can just see up to 3.8%, you will not lose. And if the market is coming down, you will make money. Okay. Even if it is coming down 2.5%, 21,700 को आ गया, you will make maximum profit. ओके, अगर फिर भी गिर रहा है, सो यू विल मेक प्रॉफिट. अगर बहुत ही ऊपर चला गया, कहीं पे भी जाने दो, सो यू विल मेक स्टिल 6%. यू इट में गो अप टू इवन 24, 25, 25, बिकॉज इट्स प्योर मैथमेटिक्स. यू हैव paid 229 rupees and you have collected 171 into two lots, which is almost equivalent to 320. So you are in a credit of 7,400. Okay, so the maximum profit is 20,000 if it is if it is closing at 21,800, or wherever it closes other than that range, you will make a consistent profit here. So likewise, if you want to convert this into maximum loss, if you want to avoid this, you can go and buy any of the edges here. So you will lose only 22,000 and the margin also will come down. If you don't buy the edges, the margins are very high. Okay, if you buy the hedges here, your maximum loss is 34,000 if it is coming here, or you'll break even 21,500 and above, wherever it may be. Market, see, 21,500, another 800 points, you will have a buffer. Even if it is coming down, you can make money, or unlimited upside you will have. This is called as like put bull spread, we call it as, which is a ratio again, because we are using the ratio. See, we have bought two put option and we have sold two put option. Okay, 1:1 ratio, two put option buy, two put option sell. That's it. No other. This is called as put bull spread, will become ratio spread with a ratio. Okay, because we have used the ratio. What if you want to do it only in call? As I told you, you can just buy here. Okay, if you buy here and you have paid 259 rupees premium and collect that premium somewhere here. Okay, 800 or 900, you can just sell two lots. The graph will become like inverted. This is called as call bear spread, we call it as. Okay, with the ratio of, again, we want to cover this unlimited loss, we'll go and buy somewhere near whichever has the highest open interest. We can just buy it. The upper limit, it will come to unlimited loss, ho gaya, 23,000 maximum loss, and the margin required is only 86,000. But market, whenever, if it is closing 23,140 and below, whatever, you can see here 77% of the probability of profit. Okay, wherever it closes, you'll make money. Even if it is, see, down by whatnot, like even if it is coming down by 10%, 20,000, you'll make 2,600 profit. Okay. Till it above 3.6%, you will make a loss. Okay. So this is the time where you have to take an action by understanding the trend. If the market turns bullish, you just remove one lot here and make it one lot. It will become a bullish strategy. Okay, and you can cut this. Okay, and go for bullish strategy. You can clear it off. That is the most, what do you say, kind of adjustment in the ratio spread. As I told you, if you are in any of the strategy of the short strangle, we can say if you have sold 23,000 call, okay, and sold 22,000 put, your range is, you can see, plus or minus 3.2%. If the market is continuously moving in one direction, you can just add any of, you can keep adding, you can bring down this 22,000 put here to here. This is called as moving strangle. We can call, if it is going in one direction, you can keep booking the profits. See here, I will tell you, if you have created this triangle, okay, on profit and loss statement, we will see here on Wednesday, okay, you have created this on the day of Wednesday, okay. If it is market is flat, you will make 5,700. Okay, if the market is 0.5% up, it will make 6,000. If market is 1%, you will still make 1%. What if the market goes up by 3%? Okay, you will be in a loss of 1,975, but not in the both the strike rate. Okay, you will make in 22,000 put option. In this option, you will make 11,600 profit. Okay, it will be here. Okay, we will book that profit and we will decrease, will come to 22,300 or 22,500. See here, even the range will keep moving up. 23,580. If you come to profit and loss statement again, okay, you will be making, if the market is moving upward on day or say Thursday, if the again market is going up, we have already booked 11,000 profit. If it is moving up, still you will be in a profit. Again, if it is moving up, it will be in profit. This call option will go under loss, but this put option will be in profit. So likewise, you can just move, keep booking and move the options. You can keep booking the profit and come nearer to the market as and when the market is going up. If it is going downward, rather than booking up, you can bring down this call option. See, you can, if, instead of selling this, if you sell 22,600, you'll get more on the downside and very less on the downside. So if at all, if it is very bearish, you just buy a put option here, done. Anything below, how much ever it may fall, you will not lose anything. Or if it is going up, you just buy a call option here. Okay, it will be keep changing. So in that way, so when you are in straddle and strangle, adding something in a ratio, right? Okay, 1:1 or 1:2. If you have bought this, okay, already this premium might have gone up. If you buy this, you can sell this and make something limited. So usually understand here these candles, right? These we call it as open interest. Okay, this red candle. Okay, there is an open interest here. So here, most of the contracts have been created. Open interest is nothing but whenever a person buys one contract, one person has to sell. So one buy and sell, we call it as one open interest. Okay. So these area, 22,400 call and put has a highest open interest for when it is red, 22,400 call option is heavily sold here. And here 22,300 call option has put option has already been sold. So usually the market ranges from, you can see here 1 SD, 1 SD. SD means standard deviation. Okay. 2 SD is again 2 standard deviation. If you come and see here, okay, so standard deviation, you can read out the definition. It gives you a market expectation on how much the stock market can move. Usually 66% chances that the stock will stay between one standard deviation. Okay. And 95% of the chances are there with it will stay in two standard deviation. So how the standard deviation is calculated and all, we will talk in the next or ongoing classes. You can easily calculate the standard deviation, but not required. This system is giving already a standard deviation, right? By uh, the square root of, we'll take the Wix value and we'll take the square root per week, per month, and per year. You can calculate the standard deviation for week, monthly, daily, everything changes the standard deviation. If you take the square root by taking the Wix, you will get the standard deviation. So usually 90% of the time, it will be ranging from two standard deviation. That's what the statistics says. and you can go with that because you can see here it is very low probability that it will reach 24,000 and it is very low probability that it will track two standard deviation. I'll tell you how you can create a simple strangle, how you can park your money with strangle, okay, straddle and all. Say suppose tomorrow, if you're on Wednesday, if you want to trade, you can just create a strangle. You go and sell an option. Okay, you come to build strategy. Okay, so where was 20,000 was the two standard deviation, right? If you come and see the 20,500 put option is at 19 rupees. You sell this. Okay. See, the probability of winning is 96%. By investing 87,000, you can make 1,200, which is 1.4%. And if you go up and see the standard deviation 24,000, right? You can go and sell a call option of 24,000. 20 rupees. So you collected 40 rupees premium, you'll make 1.7%. The probability is 92%. Invest 1.48 lakhs and leave it plus or minus 8, almost 9%. Wherever the market closes, okay, this is 30th March. How come it is? Yeah, 30th. On 7th of April, if the market closes even 5.5% down, 6% down, you make 2,500 profit, which is 1.7% on your deployed amount. Even below 8% down हो गया, फिर भी आप you will make 1.7%. If the market goes up by 8% as well, okay, not 8%, it is 7.7%, you will have a break even here. Okay, you still make around 1.7%. So usually that's where the option sellers make money consistently, because to sell an option, you don't need a real cash. If you have a portfolio, if you pledge it, you can do the selling free of cost. Okay. So that we will come to the final part when I am explaining the portfolio management. We will come to that. So how exactly, there are different ways. I think today we have covered many of the things, right? So see, monthly, if you make 1.7%, it's more than enough. Okay. You don't have to be a real in the market. So plus or minus 8%, there is very less probability. If you see the standard deviation, all the contracts have been heavily concentrated in one standard deviation. If you see here, these bars you can see, right? Green bar, red bar, these are all the open interest. People are not going beyond this. There is no option. If you see here, everyone is buying this for hedging, and you can go and sell it if you have FT amount. And if you want to hedge that, if you want to go unlimited, you can still make 1.4% without selling a call option, or you can just sell a call option and don't want to be in a put side, because if you're still bearish, not knowing it may come to if there is any black swan events, you don't want to sell the put, you can just sell one only call with 1 lakh, you still make 1,300 rupees, 1.3%. The probability is 95%. Below 24,000, wherever it closes, you make around 1.3%. It's all about where you sell it, how much risk appetite you have. Okay. Or if you want to buy this and sell this, you will become call bear spread. You still make 1.6% here. By investing only 43,000, you can make 670 rupees, which is 1.7. You can go for a multiple lots if you want. If you go for a 5 lots here and 5 lots here, you make 3,300 rupees for every 2 lakhs, which is 1.6%. The maximum loss would be, yes, the risk to reward, it is in reverse. You can just see here, risk to reward is 0.05, but the probability is very high. Okay. Likewise, you can build a ratio spread and use it as per your needs. There are multiple ratio spread. Okay. I'm showing it only in the weekly. If you go and sell in a monthly option, if you have 90 days, okay, if you I forgot to because in the weekly option, right, you saw only in the weekly option 22,300 here, 22 to 500 has the highest open interest. If you sell here and sell here, okay, plus or minus plus 7%, if it goes in a month, plus minus 6%, you get a wide range here, okay, by just using a straddle. If you go and deploy in a monthly one, you can beautifully in this week, you can just create a big strangle. You can go and sell. Okay, 20,500 put. Okay, if you see here, 10%, if the market is not coming below 9%. Okay, so there are very rare chances, right? 9%. We are already down this month 11%. Another 9%, if it is coming down, we can't do anything. That much risk is always there. The probability is 87%. If you invest 81,000, you will make 14% of the returns wherever it closes above 9%. But you will have to wait for the expiry for you to get this. Okay, so it's not only expiry. If the market continuously moving up, okay, you will make, see, in 2 days, by Monday or in by Wednesday, if the market started moving upward, you already made 3%. If it again moving, as in time goes decay, you will make already 5% here. Okay, you can just sell any put option here rather than buying a call option. If I am bullish, I rather sell a put, okay, and hedge it and leave it. Okay, I still make 14% of the returns in just 1 month, which is not a small amount. So this is the exactly a good way, okay, strategically, not predicting the market. As I told you, this option selling is purely for traders who wants to become a non-directional and have a strategy and have a predefined. You know how much you will be losing. If you want to buy this and sell this, okay, you know how much you are losing and how much you are gaining, and what is the probability, what is the investment by 45,000. Okay, if the market is not coming below 6%, you still make 12%. Man, what else you want? It is almost one standard deviation. And if you're not selling here, okay, you can buy this and have a ratio spread. Okay, by selling two lots here, you still make, see, the probability is 91%. I can go up to 98, 99%. The profit what you make will be very less if we keep on increasing the probability. It's all about the risk to reward. Okay. I hope, I think this session today, for today, I will stop this. Otherwise, it will be never ending. There are a lot of strategies. I don't want you to get confused. Understand the concept here. If you have any questions, please ask me now. I'll just, for today, I think this should be more than enough. And in the coming, we'll cover call, okay, we'll cover the covered call strategy, and we will go for caller strategy and put calendar spread. We'll talk about all this strategy. If you learn all the strategies in one day, you may get confused. Okay, so let's make it, let's not make you, because many of you are new, I believe. Okay, if 100% sure that many of them are new, 50-50. I think there are experienced player as well. So any questions, guys?
From my side, I'm clear, sir. Thank you.
Okay, anyone new, very new to this option selling? Fair. Okay, suggest any trade for Wednesday. It's already done right here. Today for Wednesday, you would have taken trade today only. Okay. For Wednesday, as I told you, I'm bit bullish by looking at the US futures and all. There is a mandatory buying of UTF. So there is a lot of pump in the US market. If the US market is doing good, we may expect some. If you see, Gift Nifty is almost 38 point plus, but the Dow Jones futures is almost 300 points up. So we have to understand the global scenarios now. For Wednesday, anyhow, you have we are like in the app, we will be giving you the recommendation if there is any trade. Uh, I'll let you know on the Wednesday itself. Okay, so any others? Are you following, guys? Let me see the chat, everyone. Okay. Yeah, I will share the recording. In fact, I'm planning to post this in our app after by recording every class.